The total value of trade was under $10 billion a year. Fast forward to today, that number is over $250 billion. China is now Africa's largest trading partner, ahead of the United States of America and Europe. But here is the part most people don't stop to think about. Every year, Africa buys more from China than is sent back. Phone, clothes, machinery, vehicles, solar panel, all flows into Africa from China. In return, Africa mainly sends out raw materials, that is oil, copper, cobalt, and timber. The question is not whether trade is happening. The real question is who is gaining more from the trade. We cannot ignore this because trade shapes power, it shapes jobs, it shapes who control value, technology, and future growth. And the China-Africa trade relationship is quietly reshaping the continent's economic direction without many Africans fully understanding how. Later in this video, we will look at what Africa actually exports to China, how debt fits into this relationship, and why some African countries are now trying to change the course. Is China really helping Africa to industrialize or just extracting resources? If trade is growing so fast, why are Africa's factories still struggling? And can Africa realistically rebalance this relationship? To understand today's trade imbalance, we first need to understand how China became so deeply involved in Africa in the first place. In the early 2000s, African main trading partners were Europe and the United States. China was present, but not dominant. In 2000, total China-Africa trade was about $10 billion. That was small compared to European trade with Africa at the time. After joining the World Trade Organization in 2001, China became the world manufacturing center. Its factories produce goods faster and cheaper than almost anyone else in the world. At the same time, China needed raw materials to fuel its growth, and Africa had exactly what China needed. By 2009, China overtook the US to become Africa's largest single trading partner. By 2023, trade had crossed $250 billion, according to Chinese and Africa trade data. That growth did not happen by accident. It followed a clear pattern. China offered African governments something Western partners often did not, that is fast infrastructure financing with fewer political conditions. China built infrastructure quickly, often financed by Chinese banks. For African leaders, this was attractive. Infrastructure was badly needed, and China delivered faster than traditional lenders like the World Bank. In return, trade between China and Africa deepened. Chinese companies came in, Chinese goods also followed. But here is where the imbalance began. Africa mainly entered the relationship as a supplier of raw material, while China entered as a supplier of finished goods. Finished goods carry higher profit margin, raw materials do not. Compare Africa trade with Europe. While Europe also imports African raw material, it buys more processed agricultural goods and manufactured products than China does. China, by contrast, imports mostly unprocessed resources from Africa and exports finished goods back to Africa. By 2015, Africa had a trade deficit with China of over $20 billion. That deficit has widened in several years since then, especially for countries without oil or major minerals. The relationship grew fast, but not evenly. China gained secure access to resources and a massive export market. Africa gained infrastructure and affordable goods, but limited industrial growth. This imbalance was not accidental. It was built into the structure of the trade itself. Let's look closely at what actually moved between Africa and China, because this is where the imbalance becomes very clear. Africa imports a wide range of Chinese products: electronics, smartphones, household appliances, motorcycles, cars, industrial machine, construction machine, textile shoe, solar panel, The list is just too long. In many African countries, over 30 to 40% of manufactured import came from China. Chinese factories produce at massive scale. This allows them to sell goods cheaper than local African producers and often cheaper than European or American alternatives. For consumers, that is a benefit. Now compare that with what Africa exports to China. Over 70% of Africa export to China are raw materials. Oil from Angola and Nigeria, copper from Zambia, cobalt from the Democratic Republic of Congo, which supplies more than 60% of China cobalt imports. Very little value is added inside Africa before exports. Here is a simple comparison. Africa exports raw copper to China. China refines it, turns it into component, wire, batteries, and electronics, then sell those finished products back to Africa at much higher prices. The same pattern applies to oil, timber, and minerals. This is not unique to China. Africa has faced this structure for decades, but China's scale made the effect much larger. Another issue is market access. Why Chinese goods enter Africa easily? African manufactured goods face barriers entering China. Not always tariff, but standard, logistic, and competition from Chinese domestic producers. As a result, African manufactured exports to China remains very small. In 2022, China exported about $150 billion worth of goods to Africa, while importing roughly $100 billion. That gap represents money flowing out of African economies every year. Who benefits from this setup? That is the question a lot of people have been asking. Chinese manufacturers gain a massive market. Chinese logistics and shipping firms gain volume. African consumers benefit from cheap goods, but African factories struggle to survive. Countries like Nigeria, South Africa, and Kenya have all seen local textile and light manufacturing industry collapse under competition from cheaper imports from China. Once factories close, skills are lost, and rebuilding becomes very hard. So the imbalance is not about numbers on a trade sheet, it affects jobs, skills, and long-term economic independence. Trade imbalance doesn't exist in isolation. It is closely tied to Chinese loans and infrastructure financing, which deepens the economic relationships and sometimes the dependency. Between 2000 and 2020, Chinese banks lent African government an estimated $160 billion, according to research by Boston University in the United States of America. On the surface, this looks like a win. Africa needs infrastructure badly. Poor road and unreliable electricity cost African economies billions every year. Chinese built projects have improved transport and energy access in many African countries. But here is a catch. Many of these loans are tied to Chinese contractors, Chinese materials, and Chinese labor. That means a large portion of the loan money flows straight back to China. African countries take on the debt but do not always build strong local industry around the projects. In some cases, loans are repaid using resource-backed agreement. Angola, for example, repays some of Chinese loans with oil shipment. This links trade, debt, and resources together in a tightrope. When commodity prices fall, as they did in 2014 and again during the pandemic, countries struggle to repay these loans. Zambia defaulted on its debt in 2020, with China as its largest bilateral creditors. Kenya now spent a large share of government revenue servicing debt, including Chinese loan. This is where trade imbalance becomes a long-term risk. If a country mainly exports raw materials, its income depends on global commodity price, which it cannot control. When export earnings fall, government cuts spending elsewhere, often in health, education, or local industry support. Compare this to East Asia countries like South Korea or Vietnam. They borrow too, but they use trade to build manufacturing capacity and export finished goods. Africa's trade structure with China has not followed that path yet. China argues that It is responding to what African countries choose to export. That is partly true, but power matters. China negotiates from a position of industrial strength. Most Africans do not. The result is a relationship that delivers infrastructure and trade growth, but also locks many countries into exporting low-value goods while importing high-value ones. And that brings us back to the central issue. Trade imbalance is not just about today's trade figure. It shapes who controls value, technology, and economic choices tomorrow. To understand why the trade imbalance with China is so difficult to fix, we need to talk about manufacturing. Manufacturing is where value is created. It turns raw materials into finished products. That is how countries build jobs, skills, and long-term wealth. China understands this better than almost anyone. Manufacturing still accounts for nearly 30% of China's GDP. In most African countries, manufacturing contributes less than 10%. One major reason is competition from import. Chinese goods enter African market at prices local factories often cannot match. A textile factory in Nigeria or Kenya pays more for electricity, transport, and financing than a factory in China. Power outages, poor road, and high interest rates all raises costs in Africa. When cheaper imports arrive, local producers lose market share drastically. In the 1980s, Nigeria had over 150 textile factories employing hundreds of thousands of workers. Today, fewer than 20 remain operational. While smuggling and policy failure played a role, competition from cheaper Asian imports, especially from China, was a major factor. The same pattern appears in footwear, electronic assembly, furniture, and household goods. Another issue is scale. Chinese manufacturers produce in enormous volume, lowering per unit costs. Most African factories are small and undercapitalized, even when government introduce tariffs to protect local industry. Smuggling and under-invoicing often undermine those efforts. China argues that African consumers benefit from cheap goods, and that is true in the short term, but cheap import also discourages long-term investment in local production. Investors hesitate to build factories if they cannot compete on price. Compare Africa with Vietnam. In the early 2000s, Vietnam was also exporting mainly raw goods, but it aggressively attracted manufacturing investment, protected key industries, and focused on export. Today, Vietnam exports electronics, garments, and machineries, including to China. Africa, by contrast, still exports raw materials and import finished goods. Supporters of China-Africa trade often point to Chinese investment as the solution, and it is true. China has invested heavily across the continent of Africa. Industrial parks, special economic zones, mines, factories, and construction projects are everywhere in Africa constructed by China. But the key question is not whether China invests in Africa. The key question is how that investment works. In many cases, Chinese companies operate as enclave. They bring in Chinese management, Chinese suppliers, and sometimes Chinese labor. Local workers are hired, but often for lower skill roles. High-value positions and decision-making remain external. For example, Ethiopia Industrial Park have attracted Chinese garment manufacturers. These factories created jobs, but wages are extremely low, among the lowest in the world. Many workers earn less than $30 a month. Meanwhile, profit largely flows back to parent company in China. In mining, the pattern is similar. In the Democratic Republic of Congo, Chinese firms control significant portion of cobalt and copper production. While governments receive royalties and taxes, most processing happens outside Africa. High-value stages of the supply chains remain abroad. In countries like Malaysia and Thailand, foreign firms were required to form joint ventures, train local staff, and transfer technology. Over time, local companies grew stronger. In much of Africa, technology transfer has been limited. Local suppliers struggle to integrate into Chinese-run value chain. This means Africa economies gain activity but not enough capability. Another issue is reinvestment. Profit earned by foreign firms are often repatriated. That means money does not circulate locally, limiting the broader economic impact in Africa. So while Chinese investment boosts GDP numbers and infrastructure statistics, it does not always translate into industrial transformation in Africa. The trade imbalance remains because Africa still exports raw materials and import finished goods even when productions happen on African soil. Trade imbalance is not just an economic issue. Over time, it becomes a political one. When a country relies heavily on one partner for trade, loans, and infrastructure, that partner gains influence even without saying a word. This is not unique to China. History shows that economic dependence often shapes political choices. China is now a major creditor, investor, and trading partner for many African countries. In some cases, China accounts for over 20% of total external debt. That creates sensitivity. At international forums like the United Nations, African countries often ally with China on issues like human rights resolutions or Taiwan. This alignment is not forced, but economic realities matter. Governments are cautious about upsetting their largest partner. There is also leverage in renegotiation. When countries struggle with debt, China becomes central to restructuring talks. Compare this with African trade with Europe. While Europe still holds influence, African countries have more diversified trade options unlike before. With China, concentration is higher, especially for resource-rich countries. However, African governments are not passive. Some are pushing back. Kenya has paused new Chinese borrowing. Zambia is reviewing mining agreement. This move signals a shift in thinking. Leaders are starting to ask not just how much trade are we getting, but what kind of trade is this creating? Because at the end, trade imbalance is about more than economics. It is about choice, leverage, and the ability to shape your own future as a continent and a country. For a long time, Africa's trade relationship with China felt fixed. Raw materials went out, finished goods came in, loans filled the gap. But over the past few years, something has started to change. It is not a dramatic break. There are no headlines saying Africa walk away from China. Instead, the shift is quieter but meaningful. Several African countries are now slowing down on Chinese borrowing. Kenya, once one of China's biggest partners in East Africa, has publicly said it will not take new loans for large infrastructure projects. Zambia, after defaulting in 2020, has become more cautious about external borrowing, especially loans tied to natural resources. Governments are realizing that infrastructure alone does not pay for itself. A railway only helps if it connects productive industry. A port only works if there are goods to export. Without local manufacturing, trade imbalance simply deepens and there is nothing Africa can do about it. Ghana restructured deals linked to bauxite and gold. Tanzania reviewed mining agreement signed in earlier years. This renegotiation aimed to increase local revenue and processing, not just extraction. There is also a growing interest in value addition. Instead of exporting raw cocoa, Ghana, Cote d'Ivoire now process more cocoa locally than before. While China is not the main cocoa buyer, the logic applies across sector. This shift matters a whole lot because it shows Africa is learning. Trade relationships are not static. They evolve as countries gain experience and confidence. China remains an important partner, but African governments are starting to ask tougher questions, not about friendship, but about structure, and that is the first step towards balance. One of the clearest lessons Africa policymakers have learned is this: dependence is risky, no matter who the partner is. Relying too heavily on China makes Africa economies vulnerable to external shocks. To reduce this risk, countries are diversifying trade partners. Trade with India, Turkey, the Gulf states, and Southeast Asia has grown steadily. India is now one of Africa's largest buyers of crude oil and pharmaceuticals. Turkey has expanded manufacturing and construction links across North and West Africa. But perhaps the most important diversification effort is happening inside Africa itself. The Africa Continental Free Trade Area (AfCFTA) launched in 2021 aimed to create a high single market of 1.4 billion people. If fully implemented, it could reduce Africa's reliance on external partners by boosting intra-Africa trade, which currently stands at 50% compared to over 60% in Europe. More trade within Africa means more opportunities for African manufacturers. A Kenyan factory selling to Nigeria or a Ghanaian processor exporting to Senegal keeps value on the continent of Africa. China understands this shift and has responded by supporting some local manufacturing initiatives, but the scales remain limited. The key point is this: Africa does not need to replace China. It needs options. With more options, negotiation power improves. Trade imbalance becomes manageable instead of structural. A common argument is that Africa simply cannot compete with China in manufacturing. Labor is cheaper in China, infrastructure is better, supply chains are stronger. But history suggests this view is too pessimistic. China itself was also considered too poor and inefficient to manufacture for the world. In the 1980s, its exports were mostly low-value goods. What changed was policy, investment, and time. Africa has advantages China no longer has: a young population, growing urban market, and rising wages in Asia that are pushing factories to relocate. Countries like Bangladesh, Vietnam benefited from this shift. Africa can benefit too. Ethiopia garment sector, Rwanda light manufacturing, and Morocco automotive exports show what is possible when policy aligns with production. Trade imbalance is not destiny. It is the result of choices made by African leaders. If Africa continues to use trade with China to demand technology transfer, local sourcing, and training, the relationship can evolve, but that requires coordination and political will.